In this video, in the week of review, Ed Yardeni addresses the current market dynamics, noting that the recent decline is driven by major companies like Walmart and UnitedHealth, which are responding to concerns about consumer sentiment and high evaluation. Ed emphasizes that earnings and valuations are the key to detriments of the stock market, forecasting that they will shape market trends for the remainder of this decade, boosted by technological and productivity advancements.
I think the consumer's still okay. I'm looking at weekly data like initial unemployment claims, and it looks like the jobs are still there, even with what's all the craziness going on in Washington. And I'm also looking at the weekly retail sales series, and that's up like 5% on a year-over-year basis. So I'm not particularly concerned that we're suddenly looking at a correction or a bear market. Bear markets are caused by recessions. I don't see a recession, and corrections are caused by fears of a recession, and maybe the tariff thing is doing it, but I don't think so.
Some look at the divergence between discretionary and staples. I don't know if we can throw, a chart up that shows what I'm talking about specifically, but the trend has not been great in terms of discretionary is the worst. There we go. Thank you. The discretionary is the worst of this year, and there's been a lot of money going into staples. Concerning to some, not you?
Well, I think it's a short-term issue here in terms of the fundamentals. The fundamentals still look pretty good across the board for consumer spending. Yeah, they're spending on consumer staples, but I've noticed that even with a weakness in home sales, furniture sales have really been very strong over the past several months. Car sales have been volatile, but they were very strong at the end of last year. A lot of discounting, so there was some weakness in January. Consumers are definitely spending on durable goods now, and that was something that they stopped doing for a while after they went on a buying binge following the pandemic. So from a fundamental perspective, I'm not particularly worried.
I mean, I played earlier a soundbite from the billionaire investor owner of the New York Mets, Steve Cohen, who's down in Miami, who talked about how he's feeling less confident about the economy for a variety of reasons that are on the mind of a lot of investors, including the likes of Citadel's Ken Griffin, who talked about tariffs, our alliances globally, and just the uncertainty that it has caused in their minds, perhaps unnecessarily. And I'm wondering how you think the average investor should think about that.
Well, life doesn't come with any guarantees, and there's always uncertainty. And I think now with this regime change between Biden and Trump, we certainly have uncertainty. But that seems to be the nature of our political cycle. We go from, one president to the next, and before you know it, we have a radical change in policymaking. And I think it takes a while for all this to settle down. But certainly there's concerns about tariffs. There's concerns about getting a budget together. And then, of course, the whole geopolitical situation looks pretty messy right now, clearly. But at the end of the day, the stock market is driven by earnings and valuation. Valuations are stretched, so we're seeing some re-rating to the downside. Even the Magnificent Seven have at least stopped going up on a valuation basis. But the earnings picture still looks really bright to me. And I think that the AI, robotics, humanoid, technology-led productivity boom is still very much with us. And I think we're going to continue to see that in better than expected profit margins and better than expected earnings. I think earnings are going to drive this market for the rest of the decade.